Hello everyone. Welcome to this week's version of Self-Direction 101, um, presented here at Camaplan every Tuesday. Um, Today we're going to go over some basics about self-direction, so I welcome everybody to answer questions and stop me at any time. I'm happy to go over any questions. Um, we have a brief disclosure to go through. Everything presented today is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. Well, we're not attorneys, CPAs, or financial advisors. So if it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. And we're happy to be included in that dialogue if that's ever needed. Um, and then we're going to go ahead and proceed. Some things we're going to talk about today. Again, it's just the basics. So, what is a self-directed IRA? What's self-direction? What types of accounts can be self-directed? What kind of investments you can make out of self-directed retirement account? What investments you can't make? How the process looks, and then we'll touch on some minor tax considerations towards the end of the presentation. Um, but that's just something to bring up with your tax professional next time you see them. So, what is a self-directed IRA or 401k? So, a lot of times you'll go to a custodian, whether it's a Fidelity, a Schwab, a Vanguard, whoever it is you invest with, and they'll tell you you have a self-directed IRA. But when they say that, that means you can direct your investments into anything off of this list. With a truly self-directed IRA like the ones offered at Camaplan, there is no list. You find the investment that is right for you, and we help you facilitate the transaction into that investment. Um, Self-directed is just an adjective that custodians put in front of these retirement accounts just to let you know that you can make these types of investments or direct your investments yourself. There is no truly quote unquote self-directed IRA. This is a quote from one of our clients that just kind of hits home on those facts. That investing what you know, understand, and can control versus using hope as your strategy. It's what our clients do every day. So a lot of people think that you can only have your funds tied to the casino of Wall Street and invest into mutual funds and publicly traded stocks. But that's not the case. You can actually use these strategies that you use with your discretionary funds, investing into alternative investments, to use those in a tax advantage fashion like the ones offered in these retirement accounts. Like I said, there is no self-directed IRA. I walk people through their applications every day, and a lot of times, the first question on the application is, "What type of account do you want to open up?" And they tell me I don't see self-directed IRA. That's because there is none. Self-directed, again, is just an adjective. These are the different types of accounts that can be self-directed. So at a high level, there are two different buckets you can look at with these accounts. You have your tax deferred bucket and your tax free bucket. The tax deferred bucket, you don't pay your taxes on the funds, your personal funds that you contribute into these accounts. However, years down the line, whatever that grows to, those contributions and those earnings, when you want to take it out of the account because you didn't pay your taxes up front, the IRS says, hey, you have to pay us on that amount that you're withdrawing from the account. Then on the other hand, you have your tax-free bucket where it's the exact opposite. So you pay your taxes on your contributions when you make them, and then whatever they grow into, those contributions and earnings, when you decide to withdraw them for a qualified distribution, those contributions and earnings that you withdraw are tax-free because again, you are already paid on the front end. We like to phrase it over here as, would you rather pay your taxes on the seed or the harvest? With the tax-free accounts, you're paying on the seed, that smaller amount, up front. And then with the tax-deferred accounts, you're paying on the harvest when you take it out, the full amount. So in the tax deferred buckets, you have a number of different accounts you can look at. You have your traditional IRA, the most common individual IRA. You have your SEP IRA and simple IRAs, which are employer linked plans, employer linked IRAs. And then you have your employer plans, these defined benefit plans and defined contribution plans. A lot of times referred to, or which accounts that fall within those defined benefit plans are or defined contribution plans are 401ks, 403bs, pension plans, things like that. Then on the other side, on the tax-free accounts, you have your Roth IRA, you have your health savings account or HSA, which is the only account of its type where the contributions are tax deferred, and if for a qualified medical expense, those distributions can also be tax free. You have your educational savings account, sometimes referred to as a Coverdell, and then those 401ks we touched on in the tax deferred bucket, depending on the employer and how they structure the plan, may allow for Roth deferrals, and you can have Roth portions through those 401ks potentially. These are some differences between the 401ks and the IRA. The main differences are 401ks tend to have higher contribution limits than most IRAs. Self-employment for solo 401ks is required. The biggest difference is 401ks are the only retirement plan that you can actually take a personal loan against, either $50,000 or 50% of the account balance, whichever of those two amounts is less. And then at the very bottom, you'll also see that UDFI rules do not apply to 401ks if certain requirements are met. UDFI stands for unrelated debt financed income. That's going to be discussed briefly when we get to the tax considerations portion of the presentation. So this is a nice little visual, and we have a good chart after this that really hits this home. On $100,000 of earnings, what do you get to keep? And these are through different avenues of making that money. So if you earn $100,000 as your W-2 or job, or your salary is your 1099. If you earn $100,000, in this example, you're in about a 40% tax bracket, so you're paying federal, state, local. You're paying Social Security, Medicare. Your employer is also paying taxes on that money that they pay you. And this will vary depending on where you're located as well, because of the local taxes. If you're in a city as opposed to a rural area. In this example specifically, out of that $100,000, you're only keeping $60,000 because you're paying $40,000 in taxes. Then right under that, you have your passive income. You're not paying an employer for passive income because they're not the ones paying you for it. So this is a little bit less in that same scenario. And the $100,000 you earn, you're only paying $25,000 in taxes. I say only, like that's not a lot anyway. And you're keeping $75,000. And now the accounts that we're talking about at the very bottom, the tax deferred and tax free accounts, that $100,000 is $100,000 you get to keep when you earn it. However, there is an asterisk next to that tax deferred column, or a row, excuse me, because when you take that money out of the tax deferred account, that $100,000, you're going to pay taxes on that $100,000 at the time of distribution. Here's that chart I was talking about that also builds off of that last example. This is for $50,000 over 40 years at a 10% rate of return in a 30% tax bracket. What that looks like over those 40 years. So you invest $50,000 with your taxable income. That's that blue bar. You invest $50,000 with your tax deferred funds on that light green bar. And then lastly, $50,000 in your tax free funds. And that's the dark green bar. Over 40 years, you can see that with compounding interest and the taxes that you're paying on that income, that $50,000 only ends up making $700,000. However, for both the tax deferred and tax free accounts over those 40 years, it's important to note that both of them earned $2.2 million. However, when you withdrew that $2.2 million out of the tax deferred account, you ended up paying $700,000 in taxes. Whereas that $2.2 million that you withdrew as a qualified distribution from that tax free account is $2.2 million you don't have to pay any taxes on. That's cash in your pocket. And so you can see why I'm a little bit partial to the Roth IRAs. Now, probably the most common question we get and different scenarios we have run by are to determine what type of investments you can make out of the self-directed IRAs. And the answer is there are a lot of different options. The most common options our clients choose and we see every day are real estate, private lending, privately traded companies, precious metals, and there are other. I've seen people invest into commodities like cryptocurrencies. I've seen people invest into agriculture, farmland, livestock. People have bought bees and sold the honey in their IRAs. There are a lot of different options as long as you structure it correctly. Of investments that you can make with these retirement accounts in this tax advantaged environment. we'll touch on the main ones a little bit in these next coming slides. So we're talking about real estate here, and we'll touch on a little bit on the other ones. If you have any specific scenarios that you'd like to run through, give us a call, ask for me or another one of the representatives in our office, and we're happy to talk about it. So real estate, when we're talking about real estate, your IRA is actually going out and purchasing physical property, and that property that can be that could be a residential property, single family, multifamily, condominiums. It could also be commercial properties, and it could even be undeveloped land. So if your IRA wants to purchase a plot of land, you can do that. And then it doesn't have to be in the U.S. We do have investors who buy properties overseas, and in other countries. There's a little bit more you want to look at when you're making these investments, and it's something that you should be knowledgeable about the other countries' transactions and real estate laws, and a number of other things that we're happy to talk over with you, if that's something you're looking at doing. But in this scenario, your IRA again is owning that property. It's not investing into a company that deals with real estate. The IRA is the actual owner. So that's one of the most common assets held at Camaplan. Another very common asset at Camaplan is private lending. So you can turn your IRA into a mini bank and actually earn what these banks are earning when they're lending money. And they can be in the form of unsecured notes, secured notes. You can secure it to a property in the form of a mortgage. Your IRA is a lender, and it can dictate the interest and principal payments that it's getting paid back for these notes. They can also be convertible notes, where it starts out as a promissory note, and then years down the line, when certain scenarios are met, that note and those terms can convert into equity into a company. You don't have to originate the note out of your IRA. Your IRA can actually purchase notes on the secondary market. So another very common asset at Camaplan. The next asset is definitely the most common we see at Camaplan, but not by much. Everybody invests. We have investments into all of these different assets, or our clients have these investments into all of these different assets that we'll go over. This is before a company goes public. So before Apple or Alphabet or any of these big companies went public, a lot of people didn't know you could invest into them with your retirement accounts. But the reality is you can. So your IRA can be an angel investor and purchase shares of a company that's not yet listed publicly, and reap the returns of that company's success, or and ride that out. But probably the most common investment at Camaplan we see is people investing into these companies that have yet to go public. Another big asset class, obviously the top four asset classes we see at Camaplan is precious metals. So your IRA can actually purchase metals, and this could be gold, silver, palladium, platinum, bullions. There's an option called the precious metals composite, which is a combination of those top four metals. And then you can also certain coins can also be purchased as well, if they meet certain requirements set by the IRS. And if you have any questions about that, we're happy to talk to you live if you call our office and talk about that. And if you have a specific precious metals supplier you'd like to work with, we can talk about that as well. Now, we just talked about a lot of things that you can invest into, not all of them, of course, but there are also rules set in place, and this is for all IRAs. Everything we're talking about today applies to all IRAs, because remember, self-directed is just an adjective. The rules for these accounts have no difference between the rules for the accounts that you may have at these brokerages. It's just with these alternative investments, there are more things that you may come across than with those vanilla investments that a lot of people make out of their retirement accounts. So the IRS has set in place some prohibited transaction guidelines to be followed within these retirement accounts. So we just went over the things that you could invest into. There are also things that you're not allowed to invest into. Mainly these things are collectibles and life insurance. So your IRA can't go out there and purchase a bottle of wine and hold on to it and expect to reap the return from the appreciation of the value of that wine or stamp or metal. You can see there that metal is listed, and that might be confusing because of our last slide, but there is an exception, as you can see below, for those U.S. government minted products, like the Silver Eagle, the different booleans that we mentioned. They have to meet certain requirements as well for quality or purity, and minting standards. But we can go over those in specific if you'd like. So one of the things the IRS says you can't do is invest in these collectibles and life insurance with your retirement account. We do have people that invest into funds that deal with these specific collectibles where they're not direct owners of the collectibles. The IRAs aren't the direct owners of these collectibles, but they're actually investing into a fund that's dealing with them. That's allowable, but just the direct ownership of these is not. More transactions prohibited by the IRS for all of these retirement accounts, not just self-directed accounts, is when you're making an investment from your retirement account. The reason they've offered these retirement accounts to us is to help as a leg of the stool for your retirement plan, to grow your retirement and supplement your income for when you decide to step out of the workforce. So what they say you can't do is that you as the account holder cannot receive any direct benefit or provide any direct benefit to these investments that your retirement accounts are making. And when we're talking about real estate, the big things are there's no personal use and there's no self-dealing. So if you own an investment property personally, your IRA can't buy it from you. You can't pay yourself, and you can't live in that property at all. It has to be an arm's length transaction again to grow your retirement account. And then you as the account holder aren't the only one prohibited from making these sort of or receiving these benefits or providing these benefits to the investments. There are a number of disqualified persons to you as well. We have a good article on this about this on our website. Mainly it's individuals of lineal ascent or descent of you, so parents, grandparents, children, grandchildren, and your spouse and a number of other individuals, and any entity that these individuals own 50% or more of or have managing control of are prohibited from receiving those benefits. So, for example, we're going to stick on real estate. If your IRA owns a property, you as the account holder can't live in it, you can't work on it, but you also can't hire your son's painting company to go in there and paint the walls. You can choose the color of paint you want the walls painted, but your IRA has to pay somebody who's going to charge a competitive price to do that work, who's not disqualified, not considered a disqualified person to the account. Now, how does the process work? So we're going to talk about it at a very high level. A lot of these steps are going to be behind the scenes. It's us just processing paperwork. But if you have any questions, we're here to make the process as simple as possible for you. So if you have any questions at any step of the way and you want to get started, our phones are always open, obviously during business hours, or you can always shoot us an email about, I'm here. What do I need to do? I don't know what paperwork's required for this step. Can you help me? That's what we're here for. So the process looks like this. Again, a lot of these steps are behind the scenes. So first you open up an account at Camaplan, similar to the account you plan on funding it from. So let's say you have a traditional IRA with a broker, and you want to use it for these alternative investments. You'll set up a traditional IRA at Camaplan and then fund the account. If it's coming from another IRA, that would be considered a transfer. If it's from an employer plan to a 401k, it'll be a rollover. Don't worry about that too much. We'll give you more information when you're actually going through the process. On average, we tell people to expect about 2 weeks for these accounts to be funded. And that's mainly up to a number of variables outside of our control, but we'll expedite it as much as possible for you. Once your account's been funded at Camaplan, you'll receive an email notification, and that's your cue that you're ready to start the investment process. You'll identify the investment you want to make. If it's a property that you want to purchase, you'll identify the details for that property. If it's a borrower you want to lend money to, you'll get the details of that note that you want to structure. Then you submit the necessary investment paperwork to Camaplan. The main thing that we need to see is our asset purchase directive, which is just our direction of investment form. Tells us what you're investing in, how much you're investing, how you like the money sent, and where we're sending it, as well as some supporting documents dependent on the actual investment or asset class that you're investing into. And we'll walk you through this entire thing. And then we process everything on our end, whether it's applications, funding documents, investment documents, or any other transactions. We process everything on our end within 2 business days of receiving paperwork in good order. And then once those that paperwork is received, we'll send the funds to the investment provider, and then all return from that investment from your IRA's investment is to be sent back to the IRA directly. And then you can feel free to rinse and repeat, make more investments, transfer in more money. And on average, I tell people from the date they open their account to the date they make their first investment. On average, that's about 3 weeks, and the biggest chunk of that time is that 2 week timeline where we can expect the account to be funded within. But again, we do everything we can to expedite the process for you. But with the funding process, there are a number of different parties that are involved as well that we can't really dictate how long they take. What do we do? So that was a lot of good information. What's stopping you from just doing it now? Why do you need us? So the IRS actually requires that you have a third party do the record keeping and report to them at the end of every year for these IRAs. We are that party. We're a neutral third party. We do the record keeping for the accounts, all transactions in and out of the accounts, and then we report to the IRS the value of the accounts at the end of every year. We're not selling anything. We don't endorse anything. We don't have any funds or mutual funds to sell you. We're not making any money off of your investments or taking anything from your earnings. We're strictly a neutral third party. We're part of your core team of professionals. So if we highly recommend you bring in your tax professionals, your attorneys, your investment advisors, if they have any questions about the process, how it works, or if they're even somewhat if they're hesitant about it. If they want to talk to us, let's get on a conference call together. Let's get on an email thread together so that we all understand the process and we structure it based off of your professional's recommendations. These are some frequently asked questions. 99% of this we already went over. If you have any additional questions, I'm happy to talk live with you over the phone if you give us a call. If you are in the audience, you have any questions, you can definitely type them. But a lot of this stuff we already went over. Lastly, we'll touch on the tax considerations. Again, at the very top of the presentation, I've mentioned I'm not a tax professional. Nobody here are tax professionals. We can't give any tax advice. This is just some things that we've seen and heard of that you might want to talk over your tax professional if you think it may apply to what you want to do with these accounts. So usually IRAs don't pay taxes, but in some instances they actually do. The two main ones that you'll hear a lot, or the only two that you'll hear really, is UBTI and UDFI. So UBTI stands for Unrelated Business Taxable Income. We'll start there. This is when, in my definition, when the IRS deems that you're using your retirement account to do things outside of the realm of what they were intended to be used for. Mainly, this is when the IRS thinks that you're running a business. So examples that I can think of that I've heard individuals investing with their retirement accounts and coming across this UBTI are flipping properties. Now, you can flip properties in your IRA, but at a certain point, the IRS looks at those properties as inventory in and inventory out, and they say, hey, you're actually running a business. We want to cut. So how many properties it is, how often, how long do you have to hold them? I don't know. The IRS will never say, and I can't speak on their behalf. Some people say if you hold them for a year, you're okay. Some people say if you only do this many a year, you're okay. But again, those people aren't the IRS, and again, the IRS will most likely never say. If you think you maybe do these taxes, definitely talk over the tax professional. Another thing I've seen or heard of triggering UBTI is if you go out, your IRA goes out and purchases a plot of land, and you decide, hey, I want to build something on it. So you hire a development company to come out and build on that land. The IRS says, hey, we think you're running a development company now. So they may hit you with taxes if you decide to do something like that. Again, talk it over with your tax professional. Next, we'll talk about is UDFI. This stands for Unrelated Debt Financed Income. We talked about it on the third or fourth slide. Between the differences between the 401ks and the IRAs. The 401k can avoid this UDFI tax if certain requirements are met with that financing. So the UDFI is triggered when your IRA receives financing for an investment it's trying to make. The IRS says, hey, you're receiving financing. We want to cut. If you do receive financing for an investment that you make out of your IRA, that it has to be through a non-recourse loan. We can talk that over in more specifics if you'd like over a phone call. But if you actually want a lot of information or actual good information about non-recourse loans, I'd recommend talking it over the non-recourse lender. But that's something that will trigger unrelated debt finance income in your IRAs, something that you may be able to avoid with 401ks. Again, these are things that you should talk over with your tax professional, because I certainly am not one. Lastly, we have a slide just showing you where IRS publications and resources, private letter rulings, court cases, and different documents, IRS documents, where we pulled this information, just so you know that we didn't make it up. So if you have trouble sleeping at night, I recommend printing some of these out and keeping them by your bedside. It might help, better than melatonin. Um, and if you have any questions about anything that's been discussed at any point, or you're looking to get started, and you need some help throughout the process, do not hesitate to give our office a call. Ask for me. I'm happy to help. Or check out our website. Look out some of our webinars, or our articles on our website that delve into a little bit more details with some of the specifics of the things that we talked about. I highly appreciate anybody who attended this live or maybe seeing this recording in the future. Can't recommend enough to give us a call, even if you're still mulling it over and you just want some more information. Always happy to speak with new people, see what they're looking to do, and hear their different experiences. So with that, that's the end of our presentation, and I hope you all have a great rest of your day.